the last 20 years have really been characterised by falling interest rates and inflation, low volatility around GDP, and where the Fed put came into play at the first sign of asset price volatility. But today we have the Fed and central banks broadly in the West tightening as economic activity slows, and we have rising inflation. So is it fair to say we are now in a fundamentally different regime?
Look, Alison, there's quite a lot to unpack there, but yes, I think broadly, I think that is correct. Our base case remains stagflation and far greater volatility in nominal GDP growth outcomes to what we've been used to. But in the shorter term, a slowdown in economic activity or even a mild recession in the West can probably be offset by a stimulus-driven recovery in the East. So we should be able to avoid a global hard landing. You mentioned inflation. On the inflation front, regardless of whether inflation has peaked, there are some, it is still materially above the Fed and the ECB's targets, and we continue to see, for example, wages, rent, food and energy prices. There are these structural elements, and that I think can prevent the Fed from, sharply reversing interest rate policy or QT. So in this next slowdown, we're going to see a shift towards, I think, a lot more fiscal activism. It really started with the exceptional Trump tax cuts and away from the, just passive outsourcing of economic policy to central banks via QE and asset price stimulus that we've seen in the last couple of decades. We expect the stimulus to focus on longer term investment areas like decarbonisation, tech and supply chain relocalisation, infrastructure. However, look, in the short term, governments are grappling with the cost of living crisis in the West, which will put further pressure on, I think, fiscal positions. So stagflation is our base case, but the range of outcomes around economic activity and inflation are very wide. And look, most importantly, I think just expect greater economic volatility, which will require, I think, a contrarian mindset to navigate in terms of the markets.
And I think the question that just about everyone seems to be asking is, do you think we've seen the bottom?
Look, the Fed has sent a pretty clear message to the market that its primary focus is to fight inflation, and the market is pricing in a Fed funds rate of around 3.5% by the end of this year. As discount rates have risen, the MSCI ACWI has fallen to around 14 times forward earnings from where it started at around 19 times at the beginning of the year. So look, equity markets have definitely reset. Arguably, the US equity market is pricing in a mild recession, whereas Europe and China are pricing in something much worse, arguably closer to a hard landing. Also, credit markets are really priced for a recession broadly across the world. US and European high yield spreads are already wider than where they were at the end of the last peak in the policy rate in late 2018. And we're only 3 months into the current tightening cycle. The credit market is saying that Western central banks have probably already over-tightened or China has been too slow to loosen policy. But, markets rarely go down in a straight line. There will be bounces along the way, and especially if we get some good news out of Europe or China, and we want to be positioned for this. Sentiment has arguably capitulated a lot more than earnings. So, the equity market may bounce even as earnings, start to reset downwards, simply because sentiment is so weak. Further, you've got forward inflationary expectations have started to fall, and hence there's probably a point where the market will start to price in, a Fed pause. So, for now, we're comfortable with our net equity at mid to high 70s in the Antipodes Global Fund, having closed out parts of our short book and tail risk hedges, which performed well in the recent dislocation. Now, given the level of economic uncertainty and the higher discount rates, I think we have an opportunity to reload. We will have an opportunity to reload some of our shorts and on the long side, the market is going to be more focused on valuations than it has been over the past sort of decade. Investors arguably just need to be more selective in a backdrop of stagflation. In terms of equity, different styles, growth and value styles will probably are more likely to become correlated in this type of environment, just as bonds and equities have continued to be more correlated. Finally, we expect equity markets will become a lot more, stock specific rather than driven by style, and tight credit conditions will see the market continue to favour these more resilient businesses with stronger balance sheets.